NovaGold operates as a development-stage mineral exploration company. Headquartered in Vancouver, British Columbia, the company's dual listing on the New York Stock Exchange, NYSE American, and the Toronto Stock Exchange, TSX, provides the liquidity necessary to support the high capital requirements of its business model. A pivotal moment in NovaGold's history was the 2012 formation of a 50-50 joint venture with Barrick Gold Corporation for the Donlin Gold Project, which established the asset as the company's sole strategic focus. This was followed by the sale of its interest in the Galore Creek Copper-Gold Project to Newmont Corporation, a transaction that provided a cash injection of approximately $503.9 million, critical for funding the long-term permitting and engineering work required for Donlin.
The most transformative development, however, occurred on June 3, 2025, when NovaGold and Paulson Advisors LLC completed a $1 billion acquisition of Barrick Mining Corporation's 50% interest in Donlin Gold. This transaction increased NovaGold's ownership stake to 60%, with Paulson acquiring 40% and assuming the role of a full and equal partner in project management. The entry of Paulson Advisors, led by billionaire investor John Paulson, is resolving a prior governance impasse and aligning the project owners toward a common objective of rapid advancement toward a construction decision.
The value proposition of Donlin Gold lies in the scale and geological quality. The project is situated on a mineralized trend that currently occupies only 5% of its total land package, suggesting substantial exploration upside beyond the current resource base. The 2025 drill program, which encompassed 18,454 meters, targeted resource conversion and geotechnical modeling to support the upcoming Bankable Feasibility Study, BFS. This program yielded an average intercepts of approximately 4.0 grams per T gold, significantly higher than the modeled deposit grade of 2.25 grams per T. Standout intervals included 41.09 meters, grading 3.06 grams per T gold, starting at a depth of 387.96 meters, and 4.38 meters, grading 26.22 grams per T gold, starting at 165.95 meters.
The current resource estimate for Donlin Gold, calculated on a 100% basis, consists of approximately 39 million ounces of gold in the measured and indicated categories, with an average grade of 2.24 grams per ton. Proven reserves are estimated at 8 million tons, grading 2.32 grams per ton, and probable reserves are 497 million tons, grading 2.08 grams per ton, for a total of 34 million ounces of contained gold in reserves. The project is designed to produce over 1 million ounces of gold annually over a 27-year mine life, with peak production of 1.5 million ounces during the initial 5 years of operation.
The technical design of the Donlin mine involves a conventional open-pit truck and shovel approach. The processing facility is designed to handle 59,000 tons of ore daily, or approximately 53,500 tons on an average throughput basis. The refractory nature of the ore necessitates a complex metallurgical flowsheet. Run-of-mine ore will undergo gyratory crushing, followed by semi-autogenous grinding, SAG, and ball milling. Gold-bearing sulfides will then be recovered through flotation to produce a concentrate grading approximately 13 grams per T, which is then pre-treated in a pressure oxidation circuit prior to carbon-in-leach (CIL) processing. Overall gold recovery from this integrated circuit is estimated at 89.8%.
Infrastructure development represents a major component of the project's technical complexity and capital intensity. Because the site is located in a remote region of southwestern Alaska, roughly 277 miles northwest of Anchorage, it lacks existing energy and transportation networks. The project plans the construction of a 316-mile or 507-kilometer buried natural gas pipeline from the existing Beluga pipeline in Cook Inlet to the mine site. This 14-inch diameter pipeline is intended to power a 227-megawatt gas-fired power plant at the mine, providing a more reliable and cost-effective energy source than diesel, which would have required expensive river barging. Other critical infrastructure includes a marine cargo port near Bethel, an upriver port at Jungjuk Creek, and a 30-mile access road connecting the port to the mine site. Construction of these facilities is anticipated to take 3 to 4 years once all permits are finalized. The valuation of NovaGold is centered on the discounted cash flow potential of its interest in Donlin Gold, with analysts focusing on the project's net present value and internal rate of return.
As the project moves toward a construction decision, the economic model remains sensitive to capital cost assumptions and commodity pricing. The 2021 Technical Report and the SK 1300 Technical Report Summary provide a baseline for these metrics, which have been updated in management presentations throughout 2025 to reflect the current price environment. The sensitivity analysis of the project's after-tax NPV using a 5% discount rate demonstrates at a gold price of $3,000 per ounce, the after-tax NPV is projected to reach $15.2 billion. At a gold price of $3,500 per ounce, the after-tax NPV is estimated to reach $19.1 billion.
The internal rate of return for Donlin Gold reflects its high initial capital requirements. At a gold price of $1,500 per ounce, the project delivers an IRR of 9.2% with a payback period of 7.3 years. While this base case return is below the 15 to 20% threshold often required by senior producers for remote projects, the sensitivity analysis indicates that the IRR improves dramatically as the price floor increases. For comparison, other development projects in 2025 have reported IRRs ranging from 20.6% for Seabridge Gold's Courageous Lake project at $1,850 per ounce to over 50% for high-grade producers in less capital-intensive jurisdictions. The evidence suggests that Donlin Gold's primary economic hurdle is the recovery of its $7.4 billion initial investment, which includes the pipeline and processing infrastructure.
Capital and operating cost estimates are a critical focus for investors as the project transitions into the BFS phase. Initial capital costs are categorized as follows. Initial capital cost, estimated at $7.4 billion to design and build the project, including the 316-mile natural gas pipeline. Sustaining capital cost, estimated at $1.7 billion over the life of the mine, or approximately $57 per ounce of gold sold. Total operating costs, estimated at $19.3 billion over the life of the mine, LOM, or approximately $635 per gold ounce sold. Management has acknowledged that the updated BFS, set to begin in 2026, will likely reflect inflationary pressures, potentially pushing the capital cost estimate higher. However, the analysis indicates that the project's high grade provides a substantial margin of safety, ensuring that cash costs remain in the lower half of the industry cost curve. The valuation of NovaGold in a peer context is driven by its price-to-net asset value, PNAV, and enterprise value per resource ounce, EV per ounce multiples. Because development stage companies lack earnings, these relative valuation metrics are the primary tools used by institutional investors to assess relative value.
The analysis reveals a significant valuation gap between gold developers and producers. As of late 2025, the average P to NAV for a universe of over 150 precious metals explorers and developers was 0.55x, well below the producer average of approximately 0.9x. This disparity suggests a re-rating as projects transition toward production. NovaGold has historically traded at a premium within the developer group, but its high price-to-book ratio of approximately 20x indicates that the market is placing a significant premium on the future potential of Donlin Gold. Key peer multiples and comparisons, early 2026 context. Seabridge Gold. Operating the massive KSM project in British Columbia, Seabridge provides an illustrative benchmark for bulk tonnage developers. Analysts have recently applied an EV to NAV range of 0.6 to 0.8x for Seabridge, with an EV per reserve ounce multiple range of $20 to $30. In relative terms, Seabridge has historically traded at a consensus P to NAV of around 0.19x to 0.38x, reflecting its early development stage and the search for a major joint venture partner.
Skeena Resources, advancing the high-grade SK Creek project. Skeena represents a late-stage developer narrative with a shorter timeline to production. Skeena's market capitalization grew significantly in 2025, and its EV/OCF for late 2025 was recorded at negative 39.23, reflecting its pre-production status. Skeena is forecast to become profitable in 2027-2028, positioning it further up the value chain than NovaGold. Integra Resources, currently trading at approximately 0.40x P/NAV versus a peer average of 1.0x for late-stage developers. Integra offers a combination of current production from its Florida Canyon mine and massive expansion potential in the Great Basin. Northern Dynasty Minerals. Valuation for the Pebble project in Alaska is heavily discounted due to regulatory vetoes.
Despite a copper-gold deposit of staggering size, 71 million ounces of gold, its market cap hovers around $938 million, reflecting the chasm created by the EPA veto. Chesapeake Gold, trading at over a 90% discount to development peers on an EV/OZF basis, Chesapeake is advancing the Matetes project in Mexico using proprietary metallurgical technologies.
For NovaGold, analyst reports suggest a target enterprise value of approximately $125 per ounce, which would represent a competitive stance relative to many junior developers currently valued around $87 per ounce in situ. The evidence suggests that NovaGold's jurisdictional safety in Alaska, ranked 13th globally on the Investment Risk Index, is a major driver of its ability to command premium multiples over projects in higher-risk regions. The financial health of NovaGold is defined by its ability to maintain high liquidity while advancing through a multi-billion-dollar development cycle. The company reported a net loss of $15.6 million for the third quarter of 2025, an increase from the $10.7 million loss in the prior year period. This loss is entirely attributable to the lack of production revenue and the high expenditures associated with the 2025 field program and BFS ramp-up. For the trailing 12 months ending August 31, 2025, the company recorded an operating loss of approximately $22.85 million and a total net loss of about $89.9 million.
Despite these losses, the company's treasury remains robust. As of August 31, 2025, NovaGold held approximately $125.2 million in cash and term deposits. This position was bolstered by an upsized public offering and concurrent private placement that raised approximately $286 million in total proceeds following the acquisition announcement. These funds were used to pay for the additional 10% stake in Donlin Gold and to strengthen the balance sheet for upcoming feasibility work. The analysis indicates that this treasury is sufficient to fund NovaGold's share of planned activities for the near term, with 2025 funding obligations for Donlin Gold estimated at $24 million. The capital structure of NovaGold is unique in its treatment of debt. The company carries a total debt of approximately $160 million, primarily in the form of a long-term promissory note to Barrick. This debt sits on the balance sheet with a debt-to-equity (DE) ratio of approximately 0.92, which is higher than the industry average for gold miners, 0.36, but is common for development stage entities with significant future liabilities. A key financial optionality for NovaGold is the ability to purchase this promissory note for $100 million if executed within 18 months of the June 3, 2025 closing date. If this option is not exercised, the debt remains outstanding under its existing terms.
The share structure as of late 2025 consists of approximately 407 million common shares outstanding. Institutional ownership is high at 57.6%. Major strategic shareholders include the Electrum Group, Paulson Advisors, and Copernic Global Investors. One-time non-cash charges, such as the $39.6 million warrant expense recorded in the second quarter of 2025, have impacted GAAP earnings but do not affect the underlying cash burn rate. The regulatory environment in Alaska has become a decisive factor in NovaGold's valuation narrative. 2025 marked a year of significant judicial de-risking for the Donlin Gold Project. A major legal victory occurred on November 14, 2025, when the Alaska Supreme Court unanimously upheld the state's decision to grant water rights and a pipeline right-of-way permit for the project. The court's ruling affirmed the Department of Natural Resources (DNR) framework, clarifying that the state was not required to consider the cumulative environmental impacts of private mineral development on private lands when authorizing the use of state waters and access over state lands. This decision significantly strengthens the project's legal foundation, as it protects the autonomy of Alaska Native corporations, such as Calista and the Kuskokwim Corporation, to manage their private resources with unwarranted state constraints.
The remaining state-level challenge involves the Section 401 Water Quality Certification issued by the Alaska Department of Environmental Conservation, ADEC. While the certification was upheld by the Alaska Superior Court in May 2025, an appeal is currently pending before the Alaska Supreme Court. The resolution of this final challenge would complete the state regulatory approval sequence necessary for construction. On the federal level, Donlin Gold has achieved a major milestone by being accepted into the FAST 41 program on October 27, 2025. This federal initiative coordinates reviews across more than 20 agencies, providing a transparent and predictable permitting timeline.
while the U.S. Alaska District Court directed the U.S. Army Corps of Engineers and the BLM to supplement the project's environmental impact statement with an analysis of a larger theoretical tailings dam release. It notably left the project's existing federal permits in place.
The estimated completion date for this supplemental federal review is May 28, 2027. This designation is expected to result in a more efficient timeline and reflects the strategic importance of the project under federal directives aimed at increasing domestic mineral production. The path to production for NovaGold follows a structured timeline designed to minimize technical risk while maximizing the project's economic robustness. The immediate focus for early 2026 is the award of the contract for the Bankable Feasibility Study, BFS. Requests for proposals were issued to top-tier engineering firms in the third quarter of 2025, with management prioritizing firms with the depth and experience to carry the project through detailed engineering, procurement, and construction management, EPCM.
The anticipated project schedule includes the following key milestones. 2026-2027, execution of the updated BFS, incorporating the 2025 drill results and updated capital and operating cost estimates. 2027, completion of federal supplemental environmental analysis and final resolution of state legal challenges. 2027-2030, estimated construction phase involving the build-out of the mine site, power plant, and 507-kilometer natural gas pipeline. 2031, targeted commencement of commercial operations. Management estimates that the BFS will cost between $80 million and $100 million and take approximately 2 years to complete. This study will be a foundational document for securing construction financing and making a final investment decision. The analysis indicates that the project's potential to produce 1.4 million ounces of gold annually in its first decade positions it to be the largest gold mine in the United States once operational.
Despite the compelling resource quality and improved strategic alignment, several project-level technical and economic risks persist. The foremost risk is capital cost inflation. The last feasibility study for Donlin was released in 2011, and the current $7.4 billion estimate is widely considered to be out of date. The 2026 BFS will be a critical test of whether the project's economics can absorb the rising costs of infrastructure and equipment in the current inflationary environment. Financing remains a significant hurdle. Securing the capital for a project of this magnitude in a remote jurisdiction may require innovative debt-to-equity structures or further strategic partnerships. Technical risks include the refractory metallurgy of the ore and the engineered pit design. Some reports have noted a risk that the engineered pit may contain 5 to 7% fewer gold ounces than the optimized shells it was based on, which could impact early-year production profiles. Logistical dependency on river barging and the seasonal constraints of Arctic operations could lead to construction delays or higher than expected transportation costs. Furthermore, the company's success is intrinsically tied to its partnership with Paulson Advisors. While governance is shared equally, differences in strategic priorities or a default by a partner could impact development timelines and costs. In conclusion, the transition to a majority ownership stake and the partnership with Paulson Advisors have effectively removed the corporate impasses that historically hindered the project's progress. Donlin Gold stands as a premier global asset, offering leverage to the gold market in a high-grade, long-life, and jurisdictionally safe format. While the project's high capital intensity and pre-production status present substantial execution risk, the de-risking achieved through the 2025 legal victories and FAST-41 acceptance provides a clearer path to production than at any time in the project's history. The primary catalysts to monitor in the coming months will be the award of the BFS contract, the resolution of the final state water challenge, and the continued delivery of high-grade drill results from the expanded site programs.